right, we know that Paul Volcker and Ronald Reagan worked well together. Volcker, then the central bank chief, aggressively raising rates to hit back on inflation. Ronald Reagan later cutting taxes to ignite an economic boom. Could it work this way again? Maybe rates not rising as rapidly or taxes coming down as mightily. To Charlie Gasparino on what he's hearing.
I mean, you really need better theme music for this segment. Love is in the air. I don't know, the Love Boat theme, something
like that. You're quite right.
You know, one of the bigger, I would say this. I've been talking to investors, and there was a question you raised before. Is there a relationship between Janet Yellen and Donald Trump that will make sure that fiscal policy, that's Donald Trump's efforts to rein in regulations and to cut taxes, is in sync with monetary policy, which is Janet Yellen's stated intent to raise interest rates? And if you don't have that in sync, there could be a real problem. We might not get fiscal policy, but Janet Yellen may raise rates for the impending fiscal policy and miss the timing, and that would screw up the markets. And what we're getting from major market participants is this, Neil, that one of the threats that they believe is the fact that there is no real stated relationship between these two, that there is not a line of communications. I don't even believe they've met yet. I might be wrong on that. I will correct it if I am wrong on that. But I've been doing my research, and we're waiting for a comment from Hope Hicks at Trump headquarters in the White House to determine that. But I don't believe they met yet. And when you're talking to sophisticated investors, this lack of relationship is the one thing they're worried about, screwing up the markets right now, screwing up its rise to maybe 21,000 or well above that, and possibly a much more vibrant economy that grows out of its 1.5% growth rate, which is pretty dismal coming out of a steep recession like we have. So now here are the scenarios, what they're worried about. Number one, that Donald Trump would not get the massive amount of tax cuts and regulatory cuts, that somehow this is going to be scaled back dramatically for a lot of reasons, as we spoke about earlier. Maybe Congress needs to pay for some of these things, including infrastructure spending. And Janet Yellen would be forced, in light of this, the possibility of this, to start raising rates. And that sort of mismatch between monetary and fiscal policy could lead to a lot of problems in the markets, i.e. the market selling off because the economy will not grow to the extent that justifies Dow 21,000. We should point out it's not that easy for the Fed chairman and for the president endorsing fiscal policy to be in sync. You can make a good case that when Alan Greenspan was cutting rates dramatically during Bush's, when Bush was in office, before Ben Bernanke was appointed Fed chairman, that laid the sort of groundwork for a housing bubble that sped up the economy so much, and it blew up obviously in the last year of the Bush presidency, leading to the financial crisis. So remember, this stuff is not science; it's an art. And it's one of the pitfalls of the market. It's something that every investor that's watching today should be very, very attuned to. Does Janet Yellen and does Donald Trump have some sort of, are they synchronized in some way between monetary and fiscal policy, which is, those are the two drivers, the ways the government drives the economy. Neil, back to you.
Real quickly then, if let's say the president doesn't get all he wants on tax cuts, is that a sign she would hold back because that stimulus is gone?
You hope so, okay? Yeah. It's just, this is such a, I mean, we don't know exactly. And now, I think Janet Yellen, just reading into her a little bit, is such a dove that she might err on the side of caution and not raise rates. But you really have to, we have to see what happens.
All right. Charlie Gasparino, thank you very, very much.